Hey everyone, welcome back to Mortgage Market Minute. I'm Chen, your mortgage broker at Simple Mortgage, and today is June 11, 2026. Every week I break down what's happening in the mortgage and financial markets so you can make smarter decisions whether you're buying a home, refinancing, or just keeping tabs on the market. Today we have 4 core takeaways. A mixed inflation report, some serious geopolitical tension that the bond market is surprisingly shrugging off, a massive week for government debt auctions, and the Federal Reserve going quiet ahead of next week's big meeting. Let's get into it. And as always, this is educational information only, not financial or mortgage advice. Our first topic is about inflation, specifically wholesale inflation, which is measured by something called the Producer Price Index, or PPI. Think of this as the prices businesses pay before they pass those costs along to you and me. Here's what happened. The headline PPI for May came in at 1.1% month over month. That's above what economists expected, which was 0.7%. So on the surface, that sounds bad, like inflation is heating up. But, and this is the important part, there is a version of this number called the core PPI that strips out food and energy prices, because those tend to swing wildly. The core PPI came in at just 0.4%, actually below the 0.5% forecast. Why does this matter for mortgage rates? Because bond traders who set the prices that influence your mortgage rate focus on that core number. A soft core reading helps keep mortgage bonds stable. We also saw weekly jobless claims come in at 222,000 versus the 220,000 estimate. That's a little elevated, but not a red flag. Bottom line on inflation, it's a mixed picture. The headline number looks hot, the core number looks cool. For now, this keeps the mortgage rate environment relatively stable. Our second topic is something you may have seen in the news. Tensions between Israel and Iran escalated significantly this week. President Trump made some pretty aggressive statements about potential U.S. military action. Now, anytime there's Middle East conflict, oil prices tend to spike, and that's exactly what happened. WTI crude oil, which is the U.S. benchmark, shot up to nearly $96 a barrel overnight, and then again near $92, before pulling back to settle around $90.22. National average gas prices are actually still down from the May high of $4.52 per gallon. As of this report, you're looking at about $4.16 at the pump nationally. The all-time high for gas prices, by the way, was $5.02 per gallon back in June of 2022. Here's what's remarkable though, despite all this geopolitical noise, the 10-year Treasury Yield, which is essentially the benchmark for mortgage rates, held steady at 4.52%. Mortgage bond prices were actually modestly higher. What that tells us is that the U.S. bond market is insulated from this international stress right now. The structural strength of the U.S. dollar and domestic economic conditions are acting as a buffer. For you as a home buyer or a homeowner watching rates, this is good news. Geopolitical headlines aren't tanking your rate environment. Alright, topic 3 is a little more technical, but stay with me. This one matters a lot. This week, the U.S. Treasury auctioned a huge amount of government debt, $58 billion in 3-year notes on Tuesday, $39 billion in 10-year notes on Wednesday, $22 billion in 30-year bonds on Thursday. That's over $119 billion in just 3 days. Why should you care? Because when the government sells that much debt, it competes with mortgage bonds for the same pool of investors. If investors don't want to buy all that government debt, yields rise, and higher Treasury yields generally mean higher mortgage rates. This week, the demand was solid, especially for the 10-year notes on Wednesday. That strong investor demand kept yields from rising and protected the secondary mortgage bond market. Stocks also rebounded after some earlier losses. This is one of those behind-the-scenes stories that never makes the headlines, but it has a very real effect on what rate you can lock in for your home purchase. The fact that these auctions went well is a quiet win for the mortgage market. Our fourth and final topic, the Federal Reserve. The Fed is now in what's called a quiet period, a mandatory window before a policy meeting where Fed officials can't make public statements or comment on monetary policy. This quiet period runs ahead of the June 16th and 17th FOMC meeting. FOMC stands for the Federal Open Market Committee. That's the group that sets interest rate policy. What do markets expect? A rate hold. The Fed is widely anticipated to keep its benchmark federal funds rate in the 3.5% to 3.75% range. No cut, no hike, a pause. Also worth noting, the US dollar index, which tracks the strength of the dollar against a basket of other currencies, is elevated at 99.88. This reflects strong global demand for US financial assets, partly because our interest rates are relatively higher than other major economies. What this means for you, with no Fed surprises expected and no Fed officials making waves in the press this week, the market is calmer. Less speculation means less volatility in mortgage rates. If you've been waiting for a window to lock in a rate, this kind of stable moment is worth paying attention to. Let's recap what we covered today. Wholesale inflation had a mixed reading. The headline number was above forecast, but the core number was cooler, which is what matters most for bonds and mortgage rates. Middle East tensions spiked oil prices temporarily, but the US bond market showed remarkable resilience. Mortgage rates held steady. A massive wave of Treasury debt was auctioned this week and demand was solid, keeping yields and mortgage rates from rising. The Federal Reserve is quiet ahead of next week's meeting, where a rate hold is widely expected. Stable, calm market conditions. The overall theme for this week? Macro pressures are real, but markets are showing underlying resilience. For buyers and homeowners, the rate environment, while not dramatic, is holding relatively steady. That's an opportunity. If you want to know what today's rates mean for your purchase power, let's talk. I'm Chen at Simple Mortgage, your mortgage expert here in Southern California. You can also find us on Facebook, Instagram, and YouTube at Mortgage is Simple. Thanks for watching Mortgage Market Minute. I'll see you next week. And remember, this content is educational only, not a commitment to lend. Rates and programs subject to change. For personalized guidance, reach out directly.